All right, hello there. I am Joe Dragoni, and this is my Section 7 assignment, doing the capital asset pricing model CAPM and the cost of equity analysis. So for this assignment, our mission was that we're working for a venture capital firm evaluating through potential investments. The boss wants to know the required return for each using CAPM, and we also want to think about showing insights about Palantir, OpenAI, and other small startups as well. So three companies we were given. We got Cloud Tech, which is a software startup, the high beta, no debt, just 100% equity financed, competing for capital with established tech firms. So this is a software startup, like we said already. Company B being Regional Bancorp, with a beta of 0.9, which is pretty close to the market average of 1, which we'll get into in a second. It's traditional banking operations and stable but slow growth. Then Company C, Green Energy Utilities with a beta of 0.5, a regulated utility company with predictable cash flows. And then some other market information we have is we have a risk-free rate of 4.5% on the 10-year Treasury, the historical market risk premium of 6%, and the S&P 500 expected return is 10.5%. So we'll use this to calculate the cost of equity, the discount rate for all of our companies that we're given. Some other additional context we got is that the Federal Reserve signaled rates may stay higher for longer, and small tech valuations have compressed 30% from their peaks. So to start into the driver framework for this assignment, entering into the define and discover stage. So our goal that we've determined is to use the capital asset pricing model, or CAPM, to analyze discount rates to determine return based on the risk, or beta in this case. We also want to consider minimum accepted return based on the risk we are taking on. So some just important concepts to go over before we really dig into the details about this. So get into our discover stage. Is that if return is greater than the CAPM rate that we calculate here, the investment is more attractive. And if the return is lower than the CAPM rate, the investment isn't as attractive given the risk we are taking on. And then going over the CAPM formula that we'll be using to calculate our cost of equity is the required return, which is expected rate of RI, equals the risk-free rate plus beta, which is our risk, times the market risk premium, which is the expected RM minus the risk-free rate. So the expected RM, like we said, being this expected return here of 10.5%. So the market risk premium will be 10.5% minus 4.5%, which should give us this 6 right here. So, like we said, this formula will be used to help us translate market risk, figure out if the return is worth the risk we're taking on. So now we'll kind of go into what beta is and what is the driver of beta. So beta measures systematic risk, or the risk by external factors that can't be avoided due to diversification, compared to unsystematic risk, which is risk that is unique to the company and can be mitigated due to diversification. So it's important to know the difference between the systematic risk and the unsystematic risk. And then just some more information about beta. It's how much a stock moves relative to the overall market, the S&P 500 benchmark. So what that means is if the beta is 1, that's just average risk and moves with the market, so it's as volatile as the S&P 500 benchmark would be. If the beta is greater than 1, which we can see with that Cloud Tech company, which had a beta of 1.8, the investment is more volatile and riskier than the market, so a larger risk premium is demanded there, larger required return. Then if the beta is less than 1, this means the investment is less volatile and it's safer than the market, so a smaller risk premium is needed. So beta is driven by the market. So like we said, if the beta is 1.8, like in the case for Cloud Tech, then if the S&P 500 grows by 10%, the company will grow by 18%, and vice versa. On the 0.5, if the S&P grows by 10%, the company will only grow by half as much. So some other things to drive beta include the industry, like tech companies have higher beta because of cash flow sensitive to things like expansion, leverage from the company, how much leverage the company has. So if a company has more leverage, it'll have a higher beta because of profits being sensitive to things like changes in sales. Same thing with company financial leverage, when they have leverage over their finances, and also the things like inflation and government events like recession. So that's the define and discover stage. We'll move on to the represent stage now, which will be mapping and visualizing CAPM integration and risk assessment. So just diving more into what the risk-free rate and the market risk premium are. So the risk-free rate is the return we can get for postponing consumption for a set period with 100% certainty of being paying back. So like it says in the name, just the return we get without taking on any risk. And then the market risk premium is the extra return demanded for holding market portfolio instead of risk-free assets. So we look at historical premiums for the market risk premium, typically, which are objective, data-driven, and stable. Sometimes they can be overly optimistic or not do a great job of representing a realistic number of what we can expect from the market. And then we compare that to forward-looking premiums, which we use to calculate the discounted cash flow model, the DCF model, on the entire S&P 500. And we look to see if the valuations are anchored in current market reality. And we can see the current fear reflected from that number. So just to sort of map out what our expected return would be using the CAPM calculation formula here, we have that 4.5% plus 1.8 times 6, which is our market premium. So 4.5% our risk-free rate right here. Then 1.8 of our beta times 6%, which is the 10.5 minus 4.5, like we talked about here with the expected return and the risk-free rate. That gives us for our higher risk company Cloud Tech with the beta of 1.8, 15.3 required return. And then for the regional bank core, just below average risk, the beta of 0.9. We use that same risk-free rate and that same market premium to get 9.9%, which is required return. Then for company C, green energy utilities, which has low risk, the beta of 0.5, which is a lot lower than the market, 4.5% plus 0.5 times 6%, 7.5% required return. So less than these other two. We can see sort of as a takeaway here, when the beta is higher, we require a higher return than what we do when it's lower. So just some other takeaways. Like we said, Cloud Tech requires significantly higher return to justify the high market risk. And then we can see down here another thing I did for the represent stage rather was calculate the security market line curve, the plot for that. So generate with help from Google Gemini, created that plot. Got the market information here, all the numbers copied over from our assignment and the betas for each company. And then using this formula here, these functions here, calculates the CAPM for each company, which will be used on our curve. And then just all of this, as you can see here, all of this code here is used to set up the plot. And then this function here, this for loop rather, right here, I think I lost it. Or no, yeah, right here. Down here is where I was, sorry, calculates or plots each point on this curve, showing where the beta is and where the return would lie. So go down to the plot now. I can see I just run it just to show that it works. This is our first SML plot line. You can see down here at the bottom, the x-axis shows the beta and the y-axis shows the required rate of return. So just looking at this line, we see the risk-free rate, as we talked about, is just the rate you get taking on zero risk. And you can see it's at the very bottom of this curve at the 0 mark for beta. And our return is low here because we're taking on no risk. And then just as we go up this curve here, we get green energy, the beta of 0.5, having a low risk of, we talked about 7.5%. And then just as you go up the curve, the star here is our market benchmark, the S&P 500, as we took away from our the assignment. And then up here, where Cloud Tech is with the beta of 1.8, shows it has the highest return. And now we can see all these points are on the same line because we're using the exact same risk-free rate and market premium for all these companies. So they won't be scattered around here. They'll be on the same line. in a little bit in the validation stage, we'll come back to this line with some other companies used for validation. But for now, we'll move on to the implementation stage. So for the implementation stage, what I did here was calculated the cost of equity using CAPM, also including sensitivity analysis for the inputs here. So up here at the top is the inputs and market assumptions that we've already talked about. So we have those in here. We've got a growth rate assumed here, used to calculate the terminal value. The information for the companies here with some projected cash flows as well. Cloud Tech signaling the high growth because of the high beta, stable growth with the around just below average beta for the regional bank, and with the low beta for green energy, the slow and predictable cash flows, which we'll come back to in a second. Just to kind of highlight what this code does for now, we have these CAPM calculations here in these functions. To calculate CAPM here, and then the calculate DCF valuation, which is our intrinsic value, using the terminal value that we had to return the total equity value and the terminal value, in calculating the present value of our future cash flows, which will be our intrinsic value. And then calculations to present division by zero in the terminal value calculation, more calculations for our cash flows to calculate the present value of those. Terminal value, as we talked about, terminal value being the estimated value beyond projected future cash flows, which helps to calculate our present value and our intrinsic value. Going down here, this fourth part here, the intrinsic value calculation again, and then that'll come out in our total equity value. So just so we have that clear, the total equity value will be our intrinsic value of our investment. And then this third section down here calculates the sensitivity analysis for beta changes in this function here, and a change in the market risk premium away from our 6% that we calculated. And then this all down here does the cost of equity calculation using the CAPM function, the DCF valuation here using the DCF valuation function just to print out all of our information, and then just printing out the last of the information. So we'll run this code real quick, and we get our VC firm valuation models here for Cloud Tech, Regional Bank, and Green Energy. So for each one, we get the beta here. So for Cloud Tech, the beta of 1.8, the cash flows that we listed out, showing some high growth in our model. And then we see our cost of equity here is the same as what we calculated, 15.3%. Our terminal value using these numbers that we found, or that we just used arbitrarily, being 280.27, and then our estimated equity value, our intrinsic value, being $206, which is lower than what the terminal value would be. And that case seems to be the same for all three. For the beta of 0.9, using these numbers, we get a terminal value of 775 with an intrinsic value of 685. I had Google Gemini calculate these numbers, so we can see they're increasing over time. This does not mean that this stock, say, Green Energy, is necessarily more valuable than Cloud Tech would be, because we don't know. We didn't get any information about what the cash flows are, what the returns are. So I think it just gave me increasing numbers for each of these three companies. And the main point being that our cost of equity that we calculated is the same as what we saw in the representation stage. And then the terminal value that we calculated being greater than what our intrinsic value is. So it shows that these stocks might be a little bit overvalued, but still reflects how beta impacts the CAPM calculation. So now going down to the sensitivity analysis for each of these three companies, it just shows that, like we can see, when beta increases, say, or beta increases or decreases rather, it'll reflect the same on our cost of equity. So if beta decreases, our required return will decrease. If beta increases, our cost of equity, our required return will increase. So there's a positive relationship between the beta and the cost of equity and required return. So I did that for all three of these companies. If you want to get a better look at it for each one, you can pause the video to look at it a little more, but this is just a sensitivity analysis showing how a change in beta will have a reflection, or not a reflection, but an impact on the cost of equity. So then moving down to our validation stage, just sort of doing some comparison with the analyst consensus or other real companies to determine how our calculations match up with what we did. So we'll look at the beta verification, the MRP check, the historical averages, and the reasonableness of the discount rate. So for cloud tech, what I did, I compared it to Tesla, being another high beta tech startup, not a startup at this point, I guess, but still a risky, volatile investment. As we can see here, looking at Tesla in Yahoo Finance, what we see here, we get the beta of 2.09 down here, which, just like cloud tech, very high risk and volatile, but with that comes the high growth and return. For this company, the average MRP, which was found out with some help from Gemini, was 5%, which is around what the MRP was for our companies. So it's close to what we calculated for our companies, not exactly consistent, as it should be, but if we change it to 6%, we can see the consistency between all of the companies, which we'll show in a second with the updated SML curve. And then our discount rate, 15.39%, makes sense because of high growth, similar to cloud tech, and the high beta equals high cost of equity. So very similar return, but it just makes sense because of, like we talked about, the positive relationship between beta and the required cost of equity. So moving on to the regional bank, which I compared to Bank of America. Bank of America actually had a beta of 1.33, which is riskier than the market. We'll look it up real quick. Bank of America Corporation, I guess because it is its own business and it's not just a regional bank, it will be on its own, in charge of its own operating leverage, but we can see it at a beta of 1.33, which means it's about 33% riskier than the market. So still not too much risk. There's more risk than the market there, but the business, like we said, being in control of its own leveraging, is sensitive to the health of the market. And then same MRP for this one, which is the same as the regional bank, so consistent, similar return to the demand. And then the year-to-date discount rate is 9.5%, which is similar to regional bank, and banks use a lot of debt, and this leverage impacts return demanded. Then the last company, Duke Energy, which I compared to green energy. So looking at Duke Energy, another company with a low beta. Going here, Duke Energy is a beta of 0.42. So low risk, volatile, low risk and not much volatility. It's highly regulated, just like green energy was, because it's just a natural monopoly, as we see down here. So regulated businesses like this are insulated from market cycles, and because of this provides stable and predictable cash flows, which is the reason for low beta. It's not, the cash flows will be predictable and not very high, like a high risk, high return company like Tesla or cloud tech. Same MRP, keeping it consistent across the board, and the discount rate being about 5.17%. Investors don't demand a high return for that. So because of that, we don't need a high discount rate. So after doing this validation, I created another SML curve with these new companies on it. Basically all the same code for that. I just had Gemini help me implement these new companies in there. So looking at this, ran the code already. You can see the required returns here that we calculated. And then looking at this new updated SML curve. We have the risk-free rate already, green energy, the market, and cloud tech still, but looking at the comparisons, we see Duke Energy and green energy relatively close to each other on the curve. Cloud tech and Tesla close to each other on the curve, and even though the regional bank and Bank of America still aren't super close to each other, they're still in between the super low risk and super high risk companies. So still reflecting that same relationship that we saw from the first SML curve. Moving on to the evolve stage here, we realized that the CAPM formula has two parts that move with the market, being the risk-free rate and the market risk premium, and different market conditions can shift these figures in different ways, because using CAPM, we kind of realized that it's almost like perfect market calculations, not really considering things like economic expansion, recession, high and low inflation, and maybe even a market crisis. So looking at economic expansion, with that, we see the risk-free rate rises, market risk premium falls, and this has sort of a push-pull impact on the required returns. When companies, our corporate profits are there in an economic expansion, and companies, the required return rises for these companies, but can be offset by falling MRP and lower beta stocks. And then in a recession, the risk-free rate falls, the market risk premium rises sharply, and this causes required returns to skyrocket because MRP completely overwhelms the small benefit from the lower risk-free rate. And this causes a lot of high-tech companies to crash because they aren't really getting those cash flows because investors are not really willing to take on as much risk like they would be in an economic expansion. And then for inflation, high and low inflation, and high inflation, this causes required returns to increase for all investments. And it's not a great scenario because this causes the SML curve to get steeper and the line to rise. And then for low inflation, this decreases required returns, and company with lower betas become more valuable because investors are still willing to take on less risk. And then also in a market shock or a crisis, this is really bad. The risk-free rate plummets to zero and the market risk premium rises sharply. Investors are not willing to take on any risk at all and, in fact, go liquid most of the time, don't even invest in the market. So this causes the SML to be almost vertical and investors panic, and the required return skyrockets for anything with a beta above zero, even if it's below 1, because safety is the top priority. And then for the last part of this, moving on to the reflection stage, the last R stage, what we kind of take away from CAPM. So what does CAPM reveal? What does it miss? CAPM shows a relationship between systematic risk and the expected required return for assets based on risk. And we use the risk-free rate, beta, the equity risk premium to calculate this. And just another thing that we kind of learned, or that I kind of took away from this, is that it's helpful to consider whether the investor wants to invest in a company that could provide high return, but deal with high risk, or just stick with something low volatility, and still will get a return, but just not as high as if you would taking the risk there. And then what CAPM fails to show is real-world scenarios, because like we talked about already, kind of seems like dealing with a perfect world. And then like back in the evolve stage, we kind of explored what would happen in different market conditions, like an expansion, a recession, a shock, or a crisis, and how inflation deals with or changes these numbers. So CAPM kind of just deals with like perfect world, no like changing conditions that could impact businesses in one way or the other. And it assumes things are efficient all the time, when in reality they're not. There's always some sort of thing happening in the market that is driving stock prices one way or the other, especially in 2025. The use of beta reveals historical information about the risk and how volatile it was in years past, but tells us nothing about the future of the investment or the confidence levels in the stock. If the stock was to lose its status as a company, then the beta from the past is useless. So definitely it reveals past information about the risk, but not much about the future. So, when we're investing in an investment, we are thinking about the future and what our returns could be. And this model sometimes just helps us to build up confidence based on the past, but doesn't really tell us anything about the future. And then just lastly, considering all this information, the main thing I was able to learn from this is that CAPN should be used as a compass to get the general direction of where we want to go with our investments, but not be used like a GPS to determine our exact location or what our actual return would be. It's important to consider other factors and our own judgment when evaluating potential investments, and that this baseline discount rate is calculated here, only showing an estimate and doesn't always or shouldn't always be 100% trusted. So, yeah, that is my Session 6 assignment, and thank you for watching.